Hey, good afternoon, everyone. Good afternoon.
Good afternoon.
Hi, Sapphire. Good afternoon.
Hello,
How are
Professor.
you?
How are you?
How are you, Claudia? How are
Afternoon,
you?
Professor.
Hi, how are you, Kadir? All right. So there are six people currently, and I hope, let me just check today's forum, and let's see. Yeah, we have more people there. I see at least, seven, right? I see seven people there. So I'm sure we're gonna have more people join us, pretty soon, right? Shortly, we're gonna have. Um, and I just want to remind you that two things, two things. One, um, on Monday we have 1 hour session, and today, Thursday, we have 2 hour session. And in 2 hour session, the cutoff point for late is uh, I usually give 20 minutes for 2 hours. But on Monday, when we have 1 hour session, the cutoff point is 10 minutes, right? 10 minutes past the hour. So, uh, generally people, come within 10 minutes, on Monday. And the same pattern. I mean, people do not change their pattern depending on how long the session is. But 10 minutes. It's better to think of it as 10 minutes. Um, the second thing to remind you of is that your quiz one starts tomorrow. Okay, your quiz one starts tomorrow. Don't forget that. Okay. All right. So I believe we were talking about ROA and ROE last time, return on equity and return on assets. So where is that? Let me open the whiteboard. Okay, this is your class. Okay, I'll put a lot of things there. All right, that is too small. All right, I can, it's just whiteboard. I can start anywhere. So the last thing, right? The reason the reason we talked about return on asset, return on equity was basically from the firm's perspective, right? From the firm's perspective, what is the metric for return, right? Um, of course, from topic one, you already know what is holding period return and what is the annualized return, which is the geometric average. In from the firm's perspective, um, and geometric return. Geometric average, holding period return. That's just a generic formula for calculating return. Now, from the firm's perspective, a direct and a straightforward measure of return is return on assets and return on equity. And last time I explained why it is direct direct measure because it is directly output to input ratio, right? Output to input ratio. And it's basically, like when we do return on, when we calculated, holding period return, the holding period can be any length of time. It can be 1 month or, 1 year, half year, 6 weeks, 8 weeks, 10 weeks. It can be any number of years. But, because no matter how long the holding period is, all you need to do is just annualize, right? Now, but then, ROA and ROE are basically annual. And so because, you are basically, the formula for ROE, I said, we know formula is basically, profit over equity, right? And this profit is basically found from the income statement, right? So it's, from the income statement. And obviously, it comes from the income statement. And the income statement is based on what operating cycle? I mean, what is the basic operating cycle? I mentioned this before. What's the basic, in other words, I don't have to ask this. I guess you guys don't answer at all. Basic operating cycle is, quarterly. Right? Basic operating cycle is quarterly. That means, in other words, you close the income statement and balance sheet. I mean, you have to close it at some point and update the data, right? Update the. So basically, how often do they do that? Basically, quarterly, and and annually. They do it quarterly and annually. For every quarter, you have to check where you stand, right? You have to check where your business is standing, right? Quarterly and annually. So think about it. This is actually, for investor relations purpose, right? In other words, companies check their own, performance every day, every week, every month. I mean, if not every day, every week, at least weekly performance. Look, you don't need to set the time frame for doing that. I mean, they do it, whenever they check their own performance, where they're standing, whenever necessary, right? But then, basically, naturally, it coincides with the time. It coincides with, the cycles, like weekly, monthly, quarterly. Now, the reason, and that's for, if you collect, and check your performance, weekly or monthly, that's for internal purpose. Internally, whenever you need it, you need to check your data. And usually, before data goes to the, think about it, before data goes to balance sheet and income statement, right? Before before data goes to balance sheet and income statement. Originally, the data is, initially data is collected through journals and ledgers. Okay, these are accounting things. I don't I don't necessarily talk about journals and ledgers, but that's basically a very crude recording of activities every day. Journals, money comes in, money goes out, that's you record that in journals. So before that, before data goes on to a balance sheet and income statement, they are recorded initially in journals and ledgers, right? And it's not organized by accounts. It's just as it happens. So by looking at journals and ledgers, you can collect the data on daily basis or a weekly basis. But balance sheet and income statement, they are updated, right? They're updated at least quarterly. Okay. Quarterly, right? And also, a company that is traded, a company that is publicly traded, right? You should understand what that means. Companies are private, either private or public. Private means the ownership is not open to public. Ownership is privately held, right? So privately held companies are not traded in the stock market, right? If they are not traded in the stock market, they're not in the bond market either, right? The companies that are publicly traded are listed in the stock market, and they are traded in the stock market. And so publicly traded companies, right, they have an obligation to disclose their financial data. So the traded companies, right, publicly traded companies, balance sheet and income statement of publicly traded companies they have an obligation to file quarterly statements with SEC. Okay, they file quarterly report with S2 or SEC. You know what SEC is, right? Anyone? Anyone? Is there anyone who doesn't know what SEC is? What is SEC? Are you there? What is SEC?
Yeah, I'm not sure.
Okay, so I'm asking you, anyone knows what SEC is?
Securities and Exchange Commission.
Yeah, Securities Exchange Commission. And who was that?
Tia.
Tia, yeah, Tia Monterosso. Okay, you're getting TI, you're getting 0.5 for that. This is section 1401. Yeah, STI Monteroso. Okay. 0.5. Yeah, they are required to file, right, quarterly reports with SEC. That's, reporting their balance sheet, right, and income statement quarterly. That's called a 10Q report. 10Q. Okay. So if they file quarterly report, that's 10Q. It's called, 10Q report. And then when they file annual report, that's called. Does anyone know what it is called if they filed annual report with SEC? That's called. Anyone? It's called a 10K report. 10K, right? So so basically, our operating cycle. Operating cycle. We have assumed, annual operating cycle. It can be quarterly, right? Basically, when we have full quarterly reports, then that's the fourth report. The result of the fourth report, when you compare it with the previous fourth quarter report, then that's that will show you annual change, right? But of course, they if you have annual report at the end of this year, it will come out only after the end of this year. Currently, we have 2021 annual report, which came out probably in January. I mean, comparing these two, right? We can have two sets of data, two sets of annual data, and we can easily find, basically we can calculate return on equity, return on assets based on these, income statement and balance sheet. And again, think about it. This profit, when we calculate, ROE or ROA, you need two balance sheets and one income statement. Two balance sheets and one income statement. And that is sort of, obvious. Why? Because think about it. You need the balance sheet at time 0, right? Balance sheet at time 0, right? And then you will need balance sheet at time 1, right? In other words, you need the balance sheet at the beginning of this year or the end of last year. And end of last year is the same thing as beginning of this year. What the balance sheet available at the beginning of this year is actually the balance sheet of last year, end of last year, right? Of course, this is a complete startup. If it is a complete startup, you don't have balance sheet of last year. I mean, balance sheet at the beginning of this year, right, is the time 0, right? The balance sheet at time 0. So you need two balance sheets and one income statement. And the income statement is, of course, income statement and time 1, right? The income statement is the horrible handwriting. Income statement. Okay, I'll just say income state at time one. Think about it. If you are, whether you are a startup or not, right? The income statement, when you have time zero and time one, right? Beginning of the year, end of the year, income statement will always have to be the one at the end of the year because all the results, right? Income statement is basically showing you the operating activity, right? So the result of the operating for the 1 year, it will have that result will be only at the end of the year, right? So you need two balance sheets, one income statement, balance sheet at time zero, balance sheet at time one, and income statement at time one. And so in the balance sheet of time zero, what kind of information are you looking at? Of course, we have, we'll have, there's current assets and non-current assets, right? And then, of course, current assets are basically working capital. Non-current assets are physical capital, physical. And it shows, of course, where they came from. It came from, of course, debt and equity, right? So I don't need to. Everything is so separate. Obviously, they came from, debt and equity. The whole thing came from debt and equity, right? Which is, basically telling you the capital structure. So the example we've been using was that the total assets, right? Total assets. We've been using this example, $100 million, right? Out of this 100 million, right? We all know all of that came from debt and equity, right? Of course, and we assumed, let's say 40% debt, right? So 40% debt, 40 million, right? Equity, 60 million, right? Right? Therefore, that's also 100 million, right? So it's balanced out, balance, right? And then this, of course, we know the capital structure. Capital structure is 40% debt, 60% equity, right? Okay. Now, so let's think about this equity, because we're talking about return on equity. Why equity? Because equity is so let me. Because equity is owner's capital, right? Equity is owner's capital, and owner equity. Let me put it this way. This is more equity at time zero is $60 million, right? Equity at time zero $60 million. And that's, we know that's owner's capital, so it belongs to the owners, right? It belongs to the owners, right? Owners are called also equity holders, right? Equity holders. Belongs to the equity holders. Okay. Think about it. I've been using the term, if you remember, and also you should remember, and not just remember, but you should, know it by, second nature. Now, there are many, terms that are used interchangeably, right? One, equity holder, shareholder, right? Stockholder, and owner, right? They all mean the same thing, right? As opposed to lender, creditor, debt holder, debt holder, or bond holder, right? They all mean the same thing, right? So owners are owners. Owners are, by paying, by, investing in equity, by investing in stocks, they gained ownership of the company, right? No matter how, small. Whereas, I was telling you a lot of times that, I used to be Apple shareholder. I'm still Apple shareholder, but there was one time I had 10 shares of Apple. It was like, 2012 through 2014, and I sold it in 2014. I sold those 10 shares, and just to realize, that, 20% gain. I mean, I bought it when it was 500 and sold it when it was 600. After I sold it, it went up to like 660, and then it split. Apple split. It was like, 7-to-1 split or 8-to-1 split, something like that. So the price, after the split, the price went down to from $660 to something like $80, $90. Of course, you can't see that price now because after split, they adjusted for split, right? All the previous price data are adjusted to reflect the post-split price. Otherwise, the data would look inconsistent. It's like proration, but anyway, so by now you should be familiar. You should be comfortable and familiar with all these names, and they mean, by you should know them by like your second nature, and it's not difficult. A lender, yeah, it's creditor is a lender. Lender holds your debt, right? If you're the borrower, the debt holder, right? Lender is also a bond holder because companies sell bond and they are holding bonds, those companies' bonds, right? So if you understand that distinction, right, then you would also understand, yeah, equity is it belongs to the equity holders, right? So that's also called paid-in capital. It's also called, where should I write it? Oops. It's also called paid-in capital. Paid-in capital. So what does that mean? Investors paid in. They injected that. They injected the capital into the company by through stocks. In other words, by buying stocks of the company. So suppose the company, this time zero is when the company went public, right? And going public means basically, the company sold stocks for the first time in the stock market, right? And if they sold, 1 million shares, so the number of shares, right? So they sold 1 million shares, right? And then as a result of that sale, $60 million were raised. The capital of 60 million, equity capital of $60 million was raised. Equity capital of $60 million were raised. So then, what was the price per share? What was the price per share? Anyone? Anyone? Is it that difficult? Is it difficult? Huh? No one can answer that? Look, they sold, 1 million shares, and as a result, they raised $60 million. So what should be the price per share?
60.
$60, right? That's not a difficult thing. Who said that? 60, who
Kelly.
said it?
Kelly?
Say it again. Kelly? Kelly, okay. Kelly. So you got 0.5. Yeah, of course. Then it's, $60, and this is called book value per share, right? At time 0. Yeah, it's called book value per share, literally, right? The total value of the equity is 60 million. There are 1 million shares outstanding. So per share price is 60. That's why it's called book value per share. Again, book value, the reason for that is this is officially the price that is on the book, price that is recorded on the book at time 0. And at time 0, the company went public, right? And here's something you have to when the company goes public for the first time, it's called IPO, initial public offering, right? IPO. Okay. Time 0 at IPO. And when they sell 1 million shares at IPO, you might think, and then, that number of shares don't change. Number of shares don't change, right? It doesn't, number of shares, that doesn't change often. In other words, what does that mean? Companies don't sell stocks every day. Companies don't sell stocks, once they sell stocks, 1 million shares, then it's going to be held, it's going to remain constant for a number of years. And why is that? Look, first of all, IPO is called primary market. And what's primary market? Primary market is literally when they sell stocks for the first time to the public. So basically, the stock changes hands, but it moves from the company. It moves from company to the first round of buyers who bought the stock in the primary market at IPO, right? And after that, you might wonder, aren't the stocks, traded every day, bought and sold? Yes, but that's why it's called traded. It's not sale, it's traded. It's trading. Why? Because after the first sale, right, after the primary market, everything is called, every transaction, every trading is happening in the secondary market. All transactions after the first primary market is called a secondary market transaction. And what is the secondary market? Then think about it. Someone bought the stock from at IPO. He bought, let's say, 1,000 shares at $60. And after IPO, let's say price went up to $65. This guy sells, and someone else buys it, right? So then, in the secondary market, the stocks basically change hands between the buyer and seller, right? Between the buyer and seller, not between the company and the buyer. Right? Does that make sense? Secondary market is where the stocks and bonds are basically, bought and sold only between the investors, not between the company and the investors. And that happens only in the primary market, only once. And then so after that, I said the number of shares remain constant for quite a while. Why? They don't sell. At some point, they will sell stocks again if they need more capital, more equity capital, right? But generally, they don't do that. Why? Think about it. The existing shareholders don't like it, right? And then who are so existing shareholders, the existing equity holders at time zero? Think about it. Equity holders at time zero. I think I better move this way. Equity holders at time zero. The stock shareholders, right? And these are, let's say some of them are not all these people have, same number of shares, equal number of shares. I mean, some have more shares, some less. Someone like me who used to hold, who used to have just 10 shares of Apple, or minority shareholder, right? But there are majority shareholders who own, maybe 10 shares of Apple was probably like 0.00001%. But majority shareholders, they generally have like 15%, 11%, 12%, 9%. I mean, even 9% is a majority shareholder. I mean, think about holding 9% of Apple. That's that's a lot. So majority shareholders, like 15%, that by 15% alone, nothing you can do. But if you can pull together the friendly shareholders, right? Friendly major shareholders, right? There's certainly, this guy, pull together like someone with, 11%, 12%, or something like that, and they vote to, and shareholders have, basically, think about it, shareholders have voting right, right? One vote per share. So then what do? All the shareholders, basically, at general shareholders meeting, someone like me, minority shareholder, won't attend the shareholders meeting, general shareholders meeting, but you get invited anyway. I mean, some, you get either email or mail, but someone who has only like 0.0001% won't go there. I mean, it's just it's not like I'm one of the big directors, so I won't. But basically the shareholders, what do? Shareholders, they elect directors, right? They elect directors at general shareholders meeting, right? And so obviously, whoever has major shares, right? Major share portions will become directors, because just by voting for myself, 15%, I can vote 15%, on myself. Whoever has 11, 12, 9%, they will all become directors. And then they form board of directors, right? Board of directors, right? And then what do they? The board of directors will elect chairperson, chairman or chairperson. Okay. Now, chair, of course, the one who can. It's basically, you know, who can pull together the most votes. And if I'm someone, you know, with 15%, and if I can if I can form an alliance with other major shareholders, I can easily reach 51%. The supermajority, 51% is the supermajority, of course, no matter what, because nothing can beat 51%. Isn't that right? 41%, I mean, cannot beat 51%. 49% cannot beat 51%. So with 51% vote, I can become the chairman, right? Chairperson. But you know, chairperson is not CEO. I mean, this is something most people do not understand. Chairperson is not automatically CEO. Chair, because in modern corporation, right? Ownership and management are separate. Right? Ownership and management are separate. Why? Because ownership is represented by board of directors. Board of directors, because board of directors represent the owners. Board of directors represent. What am I doing? Board of directors represent ownership, right? And of course, you know, chairman is the representative of the owners, right? The main representative of the owners. And management is basically hired professionals. Management is the hired professionals. Hired by whom? Well, hired by the board of directors, right? Hired by the board of directors, hired by the ownership, right? So management is basically those people with the titles like CEO, CFO, COO, CIO, you know, all these, you know, titles, you know, chief something officer, chief executive, chief financial officer, chief operating officer, chief information officer. These are the management, right? And these are the people who have been educated and trained, usually in, you know, top universities, of course, like, you know, Ivy League schools, like, you know, so they have, you know, MBAs from, like, you know, Harvard Business School, you know, Yale, MIT, you know, MBAs from Columbia, you know, University of Pennsylvania, and so on. And they have held a long, successful career in the industry for a number of years. You know, they have, so based on that track record, they are getting hired. So what is the main? So you have to understand that the running the company main job, the running the company is the job of the management, right? Running the company is the job of the management, and the job of the board of directors. What's the job of the board of directors? What's the job of the board of directors? Anyone? The board of directors, think about it. Their job is to hire and fire. This thing is. The job of the directors is to hire or fire the management, right? If the management serve their purpose, and what's the what's the goal? What's the mission of the management? Mission of the management is to maximize the shareholder wealth, right? Management's goal, their mission, is to maximize the shareholder wealth or shareholder value. Shareholder wealth, okay? I'll just put. In other words, if they maximize the profit of the company, that will maximize the share price, the stock price, and that will maximize the shareholder wealth. And if they live up to this goal, then they will keep their job. If they fail to do so, if they fail at achieving this goal, then they will get fired and they will look for new management, right? So that's the job of the, and sometimes chairperson happens to be CEO at the same time. Why? Because think about it. If you think you are the best person to run the company, you're the best person to run the company, you happen to be the majority shareholder. You have 15% share, and if you can pull together the friendly shareholders, friendly forces, and with the support of the friendly shareholders, you become the chairperson, and at the same time you can appoint yourself. I mean, that will be on the agenda, CEO, who to nominate. I mean, who to appoint as CEO. That will be on the agenda at the board of directors meeting. And at the board of directors, then the majority shareholder, I mean, who can secure like supermajority of 51%, he can run for CEO and get get elected, right? So sometimes, the chair and the CEO can be the same person, right? In the past, Bill Gates used to be the chair as well as the CEO of Microsoft. Steve Jobs too. He was, I don't know if he was a chairperson, because he may not. He may not have secured, he may not have been the chairperson, but he was one of the, of course, major shareholders of Apple. But he was also appointed to the CEO position. So he was, and then in the early days of Apple, he was, and then he got kicked out, right? 90 something, around 97, he got kicked out, and back 95, sometime around 90, 95, and then he came back. The board of directors, they got him back as the CEO around 2000, around 2008, 9, 10, and he was CEO again. And then shortly after, probably a couple of years later, 2021, that was when he died, I believe, 2021 or 20 something, 24, he died. So think about it. when we say equity holders, equity holders, at time one doesn't like their share portions to change. I mean, think about it. The reason they don't like constant sale of stocks is because if the company sells stocks, constantly, then the proportion of their shares will change. If there are 2 million shares suddenly out of blue, my holdings won't be 15%, it will be 7.5%. And besides, if there is no immediate pent-up demand, if there is no immediate demand for this stock, if you sell the next day another 1 million shares, what's going to happen to the share price? I mean, the next day, if they sell another 1 million shares, then there's usually, there can be no immediate demand for 1 million shares. And if there's just, no demand, but just twice the supply, twice as much in supply, then what's going to happen to the price? Price will drop. The price will just be halved. It will be slashed by half. And no existing shareholder wants the value of their holdings to go down by price dilution of price. The price will be diluted, right? If there is no demand. So existing shareholders don't want it. So the number of shares remain constant for quite a while until they sell new round of stocks, right? The number of shares remains constant. Okay. Alrighty. So it's 3 o'clock, I believe. So this is a good time to take a break. We'll take a 10-minute break and reconvene at 3:10. Okay. Alrighty. All right, we're back. We're back. Okay, so before the break, before we went into break, so basically I gave you, I explained what equity, how the equity holder uh, or shareholders, what it means, what equity value at time zero is. Um, So let's say at time zero, their equity was 60 million, right? And number of shares 1 million. So book value per share is $60. And of course, book value is not the same thing as market price, right? So not the same thing as market price. Market price can be above or below the book value. And especially yeah, I'm gonna talk about that more about that later, but for now, so let's say 1 year later, at time one, uh, that's where we need uh, we will see how the company has fared, how the company has performed for 1 year. So we know the income statement, we start the process, we start with the revenue. And all of these are at the end of the year value, right? Time one value. Of course, from revenue, you must subtract CGS, and you must subtract OPEX, operating expenses. Then you arrive at EBIT, right? Or operating profit, right? Then from that, you subtract interest and subtract taxes. And then finally, if you, after subtracting taxes, we finally arrive at uh, EAT, right? Everyone. So this EAT is at time one, EAT at time one, right? Net profit at time one, because as I said, um, the result of 1 year operating for 1 year operation, that's EAT. Everything culminates, right? All the performance of the company, all the operating activities culminate as EAT at time one. And let's say EAT one is 10 million. EAT at time one is 1 million, right? Now, who does this belong to? Hmm? Who does this EAT? Who does this 10 million belong to? Anybody?
The owners?
Say it loud. Say it
The
louder. Who does it belong to?
owners.
Owners. I can barely hear you. I don't. Owners are also it belongs to the owners, and owners are also called what?
Shareholders.
Huh?
I said
Shareholders.
yeah.
Yeah, yeah. Uh, it belongs to owners, shareholders. I hate writing. Shareholders or stockholders or equity holders, right? Ah, belongs to equity holders. Now, of course, profit belongs to the owners or equity holders. And who said that? Who was that?
Mukhtar.
Who?
Mukhtar.
Mukhtar. Okay. Mukhtar, you're getting 0.5. Now think about it. If it belongs to the equity holders, right? By nature of capital, in terms of nature of capital, what kind of capital is that? You understand there are only two types of capital, isn't that right? There are only two types of capital. I mean, in terms of capital source, there are only two kinds. What are two types of capital?
Debt and equity.
Debt and equity, yes. Debt and equity, yes, of course. And who said that?
Tia.
Tia, okay. Tia, you're getting another 0.5. Yes, there are only two types of capital source, right? Or it's also called capital component, capital source, capital component. The reason we've been talking about capital structure, I mean, I told you, capital structure is basically, what percentage of total assets came from debt, or what percentage of it came from equity. So there are only two types of capital, and if there are only two types of capital, this EAT, which belongs to the equity holders, it should be what? What it should be? By nature of capital, by nature or type of capital, what should it be?
Is it equity?
It's equity, of course. It's equity because it belongs to the equity holders. Otherwise, it belongs to the equity holders, so it's equity, right? So this is equity. But then, and who said equity? Who said?
Shadrach, I've seen.
Okay. What did you say?
Yeah.
Shadrach. All same. Okay, Shadrach. All right, you're getting 0.5. Shadrach. Yes, because it belongs. If it belongs to the equity holders, then it is equity. I mean, there is no other way. It cannot be debt, right? The only thing is that remember, okay, this is equity because it's equity. But the difference is, the only thing is, this is equity generated by operating activity. Equity, in other words, is equity, internally generated equity, internally. Equity by operating activity, by the company's operation, right? Equity generated by so equity generated by operating activity. Okay, so think about it. Previously, the initial equity, original equity of $60 million, initial equity of $60 million, that was externally generated. In other words, injected. It was injected by the outside, injected by the outsiders, right? From the market, from the stock market, it was injected by outsiders. So it was externally generated. And those outsiders are now shareholders, right? Before injecting the 60 million, right? They were outsiders. But after injecting that 60 million, they are all insiders, or not insiders, or what should I say? They are owners, right? So in other words, I must have said that this is paid in capital, right? This original 60 million is a paid in capital, paid in. So it's a paid in equity, meaning injected by outsiders or generated externally. But this 10 million is the equity generated by operating activity or by internally generated equity. So think about it. Keeping that in mind, so then if you look at the balance sheet at time one, right? So I wanna. Oh gosh, I gotta move this. Okay. So if you look at the balance sheet at time one, right? The equity. So I didn't have to move that, I believe. We can tell in balance sheet at time one, the equity will have changed. Equity at time one will be. What should be the equity at time one? Any idea? What should be the equity at time one? Anyone? Now think logically. Equity at time zero, think logically, please. At time zero, there was 60 million. That's equity at time one, right? And I told you they cannot sell new shares. They cannot sell new shares anytime soon. They cannot sell new shares. So obviously, number of shares won't change. It will hold. It wouldn't have changed. But equity at time zero was 60 million. And then at the end of year one, there was additional equity or newly generated equity, internally generated equity of 10 million. So then what should be the equity at, why is it moving? Why did it move? What should be the equity at time one?
Would it be 70?
Yeah, it should be 70. And who was that?
Tia.
Who said that? Huh?
Tia.
Tia. Okay, Tia, you're getting another 0.5. Yeah, it will be 70 million. In other words, equity at time one is basically what? Equity at time zero, right? Which was paid in capital plus EAT at time one. And then that will have to be 70 million. Okay. Let me move this. Come on. Why? Move. Okay. All right. Looks like sometimes it. Okay. Oh, now I can move. Okay. goodness. Yeah, it's not a difficult thing, right? Oh, no, just move. Everything is. Oh, yeah. Forget it. I'll just. Now, just bear with me. Oh, no. I'll just write again. So it's 70 million, right? Now think about it. And number of shares are still 1 million, right? Number of shares. I'm not going to write this again. It's still 1 million, right? Not dollars, but so then think about it. Book value per share at time 1, it will have to be what? Book value per share at time 1 will have to be
70?
$70. Yes, that's not a difficult thing, right? $70. And who said that?
Tia.
Who said that? Tia, you got another 0.5. So now let's think about it. Book value at time 0 was $60, and book value at time 1 is $70, which reflects exactly. Think about it. EAT was 10 million. If you divide it by number of shares, number of shares is also 1 million. If you divide it by number of shares, we know it's going to be $10, right? But what is this called? This $10 is EAT per share. In other words, profit per share. Isn't that right? Isn't that right? Because EAT is net profit, earnings after taxes. That's another name for net profit. If you divide it by number of shares, then that should be price. That should be EAT per share. EAT or profit per share, right? Everyone understands. Everyone follows. Isn't that right?
Yes.
Yeah, of course. I mean, why such a delayed response? But what is this called then? The name should be. The name should be earnings per share at time 1. Earnings per share. Why? What else can it be the name? Profit per share or earnings per share. Because it's earnings after taxes. You divide it by number of shares, so it will be per share value and it's earnings, so earnings per share, right? Then you can tell, oh, then basically book value per share at time 1 is simply book value per share book value per share at time 0 plus earnings per share at time 1. It's exactly reflecting the company's earnings per share. Book value will reflect exactly the company's earnings per share. And this is also the same thing as, look, if you divide equity at time 1 by number of shares, what is that? If you divide it by equity 1 at, right, equity 1 by number of shares, it's book value per share. You divide equity at time 0 by number of shares, book value per share at time 0. If you divide, you see what I'm saying? If you divide this by number of shares, it's this. If you divide this by number of shares, it's this. If you divide this by number of shares, it's this, right? So that's basically how the change in equity position will be reflected exactly in book value per share, and then which is also reflected by earnings per share. Also, if you think about it, what was I trying to say? Oh, I said market price will be different. Market price won't be the same thing as, market price usually represented by P, right? P will fluctuate a lot between time 0 and time 1. Why? Think about it. Market price is determined by demand and supply in the market. And suppose this was not year but quarter, right? Suppose this was at the beginning of this quarter and at the end of this quarter. I mean, the book value per share at the beginning of the quarter is based on, that's the same thing as the based on the last quarter's data, right? Last quarter's data is not available during last quarter. Think about it. This quarter's data is not available this quarter. This quarter has to end, right? And then we can compile the data from this quarter. You cannot have this quarter's data during this quarter. That's a common sense. This quarter must end, then we can have this quarter's data, right? You understand? You might say, oh, why not? I mean, don't we have today's data, yesterday's data, last month's data? Yes, we have last week's data, today's data, last month's data, but to have this quarter's data, this quarter has to end. Only when this quarter ends, right, March 31st, and then the conclusion of this quarter, will be only become available on after the end of March 31st. So this quarter's data will become available early next quarter. Just the same, last quarter's data was not available during last quarter. It became available only early this quarter, right? So when we got this, what was the equity value at time 0? That's already passed. I mean, by now, this quarter, the first quarter is January, February, March, right? So when this data is released sometime in January. So in January, the market price, because this is the total equity value as of fourth quarter 2021, and January is not that far away from that. So when we know that book value per share is 60, the market will realize, oh, the price is now too far away from the this is based on the solid data. So price is too far away from this. I mean, if it is too way above this, then there will be a correction. We will, there will be a downward correction. If it was too much below, there will be an upward correction because the market price will now approach. It will try to approach the book value. But after that, why? Because if I know that current market price was, let's say market price was, at this point, market price was like $55. If the market price was $55, then market underestimated the stock, undervalued. So we know there is a room for there is still room for the price to go up $50. I mean, if I sell, if I buy this stock, the stock at 55, it has the room for growth because the equity value guarantees $60 per share. So I buy, and it's not only me. Everyone will notice, they will buy, and then the price, as more people buy, the price will move. The price will have to go up. And once it reaches $60, there is no more incentive. There is no more reason for the price. There's no more, there's no more market force to bring it above 60. It will settle at 60. But as time goes on, so that was, early January, because the data recently got released. So this happens. But after that, late January, February, March, what's going to happen? I mean, the latest solid data was based on the fourth quarter. And after that, no new data has been made public. No new data. There's no new data, right? So in the meantime, the market tries to figure out what would be the correct price. But that's why they depend on a lot of noise. They depend on the noise. Noise means a lot of rumors and misinformation. So based on the noise, they try to something like, this is not noise, but Federal Reserve, they are going to lower the interest rate. I mean, they lower the interest, raise the interest rate. They raised the interest rate by 0.25% yesterday. So then in rising interest rate works against the valuation. So the price will go down. So in the market, because of rising interest rate, the market price will go down from 60. It will go down. Or then there are some rumors. Oh, this company, there is a certain they are developing this, and that's gonna get that's gonna, once they launch that, it's gonna be big. All those rumors, that's noise that can push up the price, right? So all these things happen between time 0 and time 1. So that's why market price fluctuates. Market price isn't going to be the same thing as book value, right? Because during between time 1 and time 0 and time 1, it's a vacuum, like vacuum of correct information, right? It's all noise. Okay, so that's what is happening between book value at time 0 and book value at time 1. All right, so that's all the time we have. It's already 3 minutes past the hour, the end of class. So, any questions so far? Any questions? Any questions? All right. If you don't have any questions, have a great day, everyone. Don't forget the quiz one starts tomorrow, and I will see you guys next Monday.
Oh,
Right?
Professor?
Yeah.
Oh, I just wanted to ask about the homework.
Who is this? Lorianne?
Yes.
Lorraine? Yeah. What about the homework? Oh, let me first. Let me stop recording and dismiss the class, and I will answer your question. Stop.